Welcome to the Drive Planning Knowledge Center. I'll be your host today, Anthony Ornella, Managing Director of Drive Planning. I think it's important to note that this video is being recorded live in March of 2019. We'll get back to the contact information before it's all said and done. But today, the Knowledge Center is going to present a case study of how the private reserve strategy is applied to real estate investing scenarios. So let's jump right in. We're going to start with a 12-month fix and flip scenario. And first, we're going to talk about some conventional methodologies. You have cash and loan. Again, you can have this argument all day long, which one is better for real estate investing. It's not what we're here to discuss. So a 12-month fix and flip, 30% tax rate. Here's the deal. You have $100,000 available to you to deploy in your cash setting. Now, your loan option, we're going to assume you have $100,000, but this $100,000 is your emergency fund. So if it's an emergency, real estate investing is not an emergency. Therefore, you don't have access to your $100,000 because it's an emergency fund. So you're going to elect to borrow and finance the deal all the way. So you have identified a property to purchase and rehab for $70,000. Same deal across all three of these situations. Now, after the funding concludes, in your cash option, you have $30,000 left in the bank. The loan, again, still nothing. You're not going to pay any interest on the cash option, and you're going to pay 5% interest on the loan. Now, I would say this is a good scenario, almost best case scenario for borrowing money at 5% there at the loan. Giving a best case scenario comparison here to be fair. So selling price, you turn and flip that house in 12 months for $120,000. $120,000 here, it's the same thing. Uncle Sam comes a knocking, he's gonna get his, all right? So your after-tax take home is $84,000 in those situations. Now, your net profit from the deal, in the cash situation, you own it, it's yours, so after tax, your net take home is the $84,000. Here in the loan amount, you have to pay it back. So you're going to get a $10,500 take home after profit, after tax, and loan repayment. So the capital available for your next deal is you have $114,000 over here, which is your after funding plus your profit. And this here is 10.5, which is just your net profit. So you increased your buying power by $14,000, increased your buying power by $10,500. Again, I realize I did not include a down payment here. We're going to assume for ease of comparison, there's no down payment necessary for this deal to occur. So there are your two conventional methods. What about a better way to bank? Okay, so here's the capital, here's our buying power generation. Let's talk about utilizing the private reserve strategy to get this deal done. Same deal, you have $100,000 of equity built up into your private reserve. Same property. Here's a big differentiator though. When you borrow or collateralize a loan from your private reserve, your $100,000 remains in force inside the private reserve. Now you don't have access to it because you have $70,000 cash in hand. So there's a lien against $70,000 within your private reserve. However, the $100,000 is never drawn down. That money is going to earn on average of 5%. That's kind of on the lower end of the middle of the pack, I would say. I want to kind of be representative of both the high end and the low end here. So we chose 5%. That's going to earn over your 12 months alongside of your flip. The interest you're going to pay for that collateralized loan is 4.5%. That is the highest interest rate that I have seen with the programs that we run for the private reserve strategy. So this is a worst case scenario here versus a best case scenario over here. Now with the 4.5% loan, it's important to note that these loan repayments, and there's no negotiation with the bank. This is a wire transfer of money from your private reserve to your checking account or whatever you're using. It does not function just like an amortized loan. The repayment structure is much different. However, for ease of comparison, we're going to just keep moving on to compare through repayment as an amortized loan. Sale price is the same. Your after-tax take-home is the same. Your net profit is a little bit better than your loan option because it's 4.5%. So you got $10,850. Now, you have to include, over that 12 months, you've earned 5% on your $100,000, so you have an additional $5,000 of tax-free growth inside your private reserve over that time period. leaving your capital for the next deal $115,850. So you've increased your buying power better than both scenarios, and you have more capital to deploy. So where did that come from? Well, the power comes while you're repaying the loan out of your net profit. The underlying principal of $70,000 is going back into your private reserve. So you're paying the interest. You're not manifesting money out of nowhere. You've built up the equity. When you borrow the money, it's more efficient because when you borrow from yourself, you pay yourself back that money. So you're reducing the lien on your $100,000 by restoring the underlying principal. You got your tax-free growth plus your net profit brings you to just a better gain. If you repeat this with the exact same scenario, your next starting capital is $115,850 that you're going to earn 5% over. And that will further distance itself from this number and these numbers. So it's a 12-month fix and flip. You can see it's just a more efficient way. It's fast, it's fluid, no negotiation with bank. We talk about velocity of money. This allows for a greater velocity because there is less talking and more doing. So let's get into a 30-year rental option. Different factors to consider when you're talking about a 30-year rental. Purchase price of $100,000 for your property. We're going to assume a 3% appreciation rate on those properties. Cash flow before expenses, before any payments made, cash flowing $1,000 a month. You're going to hold that for 30 years, aka 360 months. Assume tax rate again remains at 30%. So let's see what our conventional methods look like. So with the cash option, the appreciation is going to remain the same in all three of these situations. Your property is going to appreciate $272,726 over that 30-year time span. And so that investment, that unactualized investment, we're not selling this property. We're going to assume this is just a look at 30 years. If you were to sell the property, what the potential of the profit is over that time span. Because you own the property outright with the cash buy, your cash flow of $1,000 a month is right into the pocket. Pretty easy math there. 360 months, $1,000 a month. That's $360,000 over a 30-year time span of profit from that property. So your gross profit between appreciation and cash flow, $632, $726. Your after-tax take-home, again, appreciation not taxed because we have not sold it, so it's just the cash flow being taxed. Your after-tax take-home at 30 years, $524, $726. And including the acquisition cost of that property, $424, $726 over a 30-year time span. So a good cash flowing asset through a cash loan, the same deal. Appreciating, it's going to cash flow, but we're electing to repay the loan from the cash flow. So the cash flow is going to be reduced over that 30 years to $167,000. Again, assuming 5% interest rate over that time period. Gross profit, a little bit less than your cash option, and your after-tax profit, again, only taxing your cash flow. It's $389,626, which is your net profit. Again, the loan has been repaid. You don't have to factor in acquisition cost because we have factored that in with your loan repayment over time. So you can see and compare, and again, you can make this argument all day long. Which one's better? We're here to talk about the private reserve strategy and how to truly accelerate your real estate game. The same situation with the fix and flip. Here we go. Private reserve, you use a collateralized loan to grab your $100,000 property. Appreciation remains the same. We're going to elect to repay it just like an amortized loan, even though you have much more flexibility. And we're going to pay that loan down via the cash flow monthly. So your cash flow reflects, these numbers are going to be identical to the loan amount for ease of comparison. I've kept it that way. So again, at that 30-year mark, your property, your rental property, is worth $389,626. So what's the big hooey? What's the big deal? What's the differentiator? Differentiator is the equity that you have built up within your private reserve remains in force that entire time. You've had $100,000 sitting alongside your other $100,000 property. This money has had a lien on it, but it doesn't get reduced and it continues to earn tax-free money. Again, assuming that middle of the pack 5% gain annually, that money is going to grow tax-free to $432,194 along with your rental property. So at the end of 30 years, you have $821,820 free and clear, tax-free stuff. This is ready to go money, whether it's retirement or next deal or whatever it is at year 30. That is the money that you have generated and created through a more efficient way to bank. But wait, there's a little bit more, and this is where it gets really exciting. What are you going to do with that extra cash flow? If you are a earn, invest, repeat type person, maybe that extra cash flow, your W-2 job is taking care of the family. You're using that extra cash flow to save up and go into your next deal. So where do you put that money? You go into a bank, or do you go into your private reserve? So what's that look like? So where did I get this 463? That is your monthly cash flow after your loan repayment. Your loan repayment is going to reduce the lien on your $100,000. So you're actually getting a better return on your cash flow than this 463, but we're talking about just extra here. So if you take that extra cash flow and you put it back into your private reserve, so 463 a month for 360 months, and this is again one rental property through the private reserve, that extra cash flow injected back into your private reserve, your personal bank, is going to grow tax-free to $385,336 over that 30-year time span. What does that mean for you? Off of one rental property through a more efficient way to bank, you've taken your net profit from the rental property plus your tax-free growth of the original cash value plus the extra contributions and its growth at 385, 336 tax-free. That brings your 30-year total to $1.2 million off of one rental property. So again, this methodology, this private reserve strategy, is it for everyone? No. If you're comfortable doing it the way you've always done it, then this is not going to be for you. But if someone is looking for something that is going to accelerate their game, more tax advantage, more growth, more passive income generated alongside stuff you're already going to be doing. This is similar, if not the exact same thing. You're building equity. You're building up a savings account. It's the exact same way. It's just more efficient. If you're looking for something that's going to increase your efficiency, you're going to look for something that is going to increase the protection of the game. If you're going to look to become your own bank and have your private reserve to really, really put a power punch to your next real estate deal, this is something that you should consider. Drive Planning has a real estate investor's guide to success program where we teach real estate investors how to implement the private reserve strategy into their business, into their lives. And this can be used for far more than real estate investing. And with that, follow us on Facebook and subscribe to our YouTube channel to stay up to date with all the different case studies that the Knowledge Center is kicking out. Feel free to reach out directly to me. You can find more at driveplanning.com. And we look forward to serving you down the road. This is Anthony Ornello with Drive Planning Knowledge Center, signing off.